Welcome. Today we're diving into one of the most important concepts in stock investing, diversification. Whether you're a beginner or have some experience in the market, understanding diversification can make a huge difference in your investment journey. In this video, we'll explore what diversification means, why it's so crucial, and how it can help you manage risk and potentially boost your returns. Let's start by breaking down the basics and setting the stage for a smarter investment strategy. Diversification is a strategy that involves spreading your investments across different assets, industries, or sectors. The main idea is simple: don't put all your eggs in one basket. By owning a variety of stocks, you reduce the impact that any single investment's poor performance can have on your overall portfolio. This approach helps smooth out the ups and downs of the market, making your investment experience less stressful and more stable over time. You might wonder, why is diversification so important? The answer lies in risk management. When you invest in just one or two stocks, your portfolio's fate is tied to the performance of those companies. If one fails, your losses can be significant. But with diversification, even if one stock drops, others may rise or remain stable, helping to balance out your returns. This is why seasoned investors always emphasize the value of a diversified portfolio. Diversification isn't just about owning different stocks. It can also mean investing across various sectors, industries, or even asset classes like bonds and real estate. For example, you might hold shares in technology, healthcare, and consumer goods companies, or you could combine stocks with bonds to further reduce risk. The more diverse your investments, the better protected you are from unexpected market swings. Let's look at a simple example. Imagine you invest all your money in a single tech company. If that company faces a setback, your portfolio could take a big hit. But if you spread your investment across several companies in different industries, a problem in one area won't drag down your entire portfolio. This practical approach helps you weather market storms and keep your investment goals on track. History shows that diversified portfolios tend to perform better over the long term compared to concentrated ones. During market downturns, diversified investors often experience smaller losses because their holdings are spread out. This doesn't mean you'll never lose money, but it does mean you're less likely to suffer severe setbacks from any one investment. Over time, this can lead to more consistent growth. Volatility is a normal part of investing, but diversification helps you manage it. When one sector is down, another might be up, balancing your overall returns. This smoothing effect can make it easier to stay invested during turbulent times, reducing the temptation to panic sell when markets get rough. Staying the course is often the key to long-term success. Sector diversification means investing in companies from different parts of the economy, like technology, healthcare, finance, and energy. Each sector reacts differently to economic changes, so spreading your investments across sectors can help protect your portfolio from sector-specific downturns. This approach ensures that your success isn't tied to the fate of just one industry. Even within a single sector, there are many industries. For example, the technology sector includes software, hardware, and internet companies. By investing in different industries, you further reduce the risk that a downturn in one area will hurt your entire portfolio. This layered approach to diversification adds another level of protection for your investments. Geographic diversification involves investing in companies from different countries or regions. Global markets don't always move in sync, so international investments can help offset losses in your home market. This strategy opens up new opportunities and can lead to a more balanced and robust portfolio, especially during times of local economic uncertainty. Diversifying across asset classes means including not just stocks, but also bonds, real estate, or commodities in your portfolio. Different asset classes often react differently to market events. For example, when stocks fall, bonds may rise. By mixing asset types, you can further reduce risk and create a more stable investment experience. Mutual funds are a popular way to achieve diversification. These funds pool money from many investors to buy a wide range of stocks or other assets. By investing in a mutual fund, you instantly gain exposure to dozens or even hundreds of different securities, making it easier to diversify without picking individual stocks yourself. ETFs are another tool for diversification. Like mutual funds, ETFs hold a basket of different securities, but they trade on stock exchanges like individual stocks. This gives you flexibility and liquidity, along with the benefits of diversification. ETFs come in many varieties, covering different sectors, regions, and asset classes. Investing in individual stocks can be rewarding, but it's also riskier if you don't diversify. Funds like mutual funds and ETFs make diversification easier, especially for beginners. However, some investors prefer to build their own diversified portfolios by carefully selecting individual stocks from different sectors and industries. Common question is, how many stocks should you own to be diversified? While there's no magic number, many experts suggest holding at least 15 to 20 stocks across various sectors and industries. This helps ensure that no single investment can dramatically impact your portfolio's performance. While diversification is important, it's possible to overdo it. Owning too many stocks or funds can make your portfolio hard to manage and dilute your returns. The key is to find a balance, enough diversification to reduce risk, but not so much that you lose track of your investments or pay unnecessary fees. Correlation measures how investments move in relation to each other. For true diversification, you want assets that don't all move the same way at the same time. By combining investments with low or negative correlations, you can better protect your portfolio from market swings and unexpected events. Over time, some investments will grow faster than others, causing your portfolio to drift from its original allocation. Rebalancing means adjusting your holdings to maintain your desired level of diversification. This might involve selling some winners and buying more of underperforming assets to keep your risk in check. Diversifying your portfolio can sometimes increase costs, especially if you're buying many individual stocks or funds with high fees. It's important to watch for trading commissions, management fees, and other expenses that can eat into your returns. Choosing low-cost index funds or ETFs can help you diversify efficiently. Diversification can also have tax implications. Selling investments to rebalance your portfolio may trigger capital gains taxes. It's wise to consider tax-efficient strategies like using tax-advantaged accounts or harvesting losses to offset gains to keep more of your returns. Some investors think they're diversified just because they own several stocks, but if those stocks are all in the same sector or industry, risk remains high. Another mistake is chasing hot trends and neglecting balance. True diversification requires thoughtful planning and regular review of your holdings. Diversification isn't just about numbers, it's also about peace of mind. Knowing your investments are spread out can help you stay calm during market downturns and avoid emotional decisions. This psychological benefit is one reason why diversification is a cornerstone of successful investing. During bull markets, when stocks are rising, it can be tempting to concentrate your investments in the hottest sectors. However, diversification remains important even in good times. Markets can change quickly, and a diversified portfolio helps you participate in gains while protecting against sudden downturns. In bear markets, when stocks are falling, diversification can help cushion your losses. While no strategy can eliminate risk entirely, having a mix of assets can reduce the impact of market declines and help you recover faster when conditions improve. Over the long run, diversification is one of the best ways to achieve steady growth while managing risk. By spreading your investments, you give yourself the chance to benefit from different market trends and reduce the impact of inevitable setbacks. This approach supports your financial goals and helps you stay invested for the long haul. As you approach retirement, diversification becomes even more important. You may want to shift some investments into more stable assets like bonds to protect your savings from market volatility. A well-diversified portfolio can provide income, growth, and peace of mind throughout your retirement years. Young investors have time on their side, but that doesn't mean they should ignore diversification. Starting with a diversified portfolio helps build good habits and protects against early setbacks. Over time, this approach can lead to greater wealth and a smoother investment journey. Even experienced investors benefit from diversification. As your portfolio grows, maintaining a balanced mix of assets becomes more challenging but also more important. Regularly reviewing and adjusting your holdings ensures you stay on track and continue to manage risk effectively. It's important to remember that diversification can't eliminate all risk. Market downturns, economic crises, and global events can affect nearly all investments at once. However, diversification remains your best defense against the risks you can control, helping you weather storms and recover more quickly. Trying to time the market buying and selling based on predictions rarely works out well. Diversification allows you to stay invested through market ups and downs, reducing the need to guess the perfect time to buy or sell. This steady approach often leads to better results over time. Building a diversified portfolio starts with understanding your goals, risk tolerance, and time horizon. From there, you can choose a mix of stocks, bonds, and other assets that fit your needs. Remember, diversification is a process, not a one-time event. Regularly review and adjust your portfolio as your situation changes. There are many tools available to help you diversify, from mutual funds and ETFs to robo-advisors and online platforms. These tools make it easier than ever to build and manage a diversified portfolio, even if you're just starting out. Take advantage of technology to simplify your investment process. Once you've built a diversified portfolio, it's important to monitor your investments regularly. Check your asset allocation, review performance, and make adjustments as needed. Staying engaged helps you catch problems early and keep your portfolio aligned with your goals. Discipline is key to successful diversification. Resist the urge to chase trends or make big changes based on short-term market movements. Stick to your plan, rebalance when necessary, and focus on your long-term goals. This steady approach is what sets successful investors apart. Every investor makes mistakes, but the important thing is to learn from them. If you find your portfolio is too concentrated or not performing as expected, take the opportunity to adjust and improve your diversification strategy. Continuous learning is part of the investment journey. If you're unsure how to diversify your portfolio, consider seeking advice from a financial professional. Advisors can help you assess your goals, risk tolerance, and recommend a diversified mix of investments tailored to your needs. Don't hesitate to ask for help if you need it. Your financial goals should guide your diversification strategy. Whether you're saving for retirement, a home, or your child's education, a diversified portfolio can help you reach your objectives while managing risk. Align your investments with your goals for the best results. Diversification isn't a set-it-and-forget-it strategy. Markets change, and so do your needs. Make it a habit to review your portfolio at least once a year or whenever you experience major life changes. This ensures your investments continue to support your goals and risk tolerance. Patience is a powerful ally in investing. Diversification works best over time, allowing you to benefit from compounding and market growth. Resist the urge to make frequent changes and trust in your diversified strategy to deliver results in the long run. It's easy to get caught up in market headlines and news stories. While staying informed is important, don't let short-term news drive your investment decisions. A diversified portfolio helps you stay focused on your long-term plan, no matter what's happening in the markets. As you move through different life stages, your diversification needs may change. Young investors might focus more on growth, while retirees prioritize stability and income. Adjust your portfolio as your goals and circumstances evolve to maintain the right balance. Having a diversified investment portfolio is important, but so is keeping some cash or liquid assets for emergencies. This safety net ensures you don't have to sell investments at a loss if unexpected expenses arise. Diversification works best when combined with a solid financial foundation. Inflation can erode the value of your money over time. Diversifying into assets like stocks, real estate, or commodities can help protect your portfolio's purchasing power. A well-diversified mix gives you a better chance to outpace inflation and grow your wealth. Technology has made diversification easier than ever. With online platforms, apps, and robo-advisors, you can build and manage a diversified portfolio with just a few clicks. Take advantage of these tools to simplify your investment process and stay on top of your strategy. Wrap up: diversification is a cornerstone of smart investing. By spreading your investments across different assets, sectors, and regions, you can manage risk, smooth out returns, and stay focused on your long-term goals. Remember, it's not about eliminating risk entirely, but about making it manageable. Start diversifying today and set yourself up for a more secure financial future.